Hello everyone, welcome to today's information about the U.S. economic market.
Dow drops more than 500 points after ugly inflation report upsets markets' rate cut expectations. By Vivian Lu Chen. February 13, 2024, 4:02 p.m. Eastern Time. January's hotter-than-expected inflation report threw the financial market into a tailspin on Tuesday and upended investors' expectations of how soon and by how much the Federal Reserve might start cutting interest rates. Stocks tumbled, with the Dow Jones Industrial Average finishing down by 524.63 points. Treasuries sold off aggressively, pushing yields to their highest levels since December. And the ICE US dollar index DXY jumped 0.7% to a three-month high. January's Consumer Price Index report, out Tuesday morning, suggests that the road toward the Federal Reserve's 2% goal for U.S. inflation is going to be more than simply bumpy. It's possible that investors and policymakers may have completely misjudged how powerful inflation will be, although it will take at least one more month of data to prove the point. Until then, the higher-for-longer theme in interest rates reverberated on Tuesday, with traders pushing the likely timing of the first Fed rate cut back to June, and with the one-year Treasury yield BX-1Y touching 5.01%. If this continues, we are in a no-landing and no-rate-cut scenario, where economic growth stays above trend, unemployment stays low, and you keep getting inflation surprises, said Ben Emmons, a senior portfolio manager and head of fixed income at New Edge Wealth in New York. You can't expect inflation to decelerate with the economy growing faster. You need growth to be below trend. Even before January's CPI report, parts of Wall Street were contemplating scenarios in which the Fed might not cut rates all this year, and investors might need to factor in the risk of rate hikes. One big reason is that the economy may be in an environment in which the so-called neutral rate of interest that neither stimulates nor restricts growth may have moved up. There have been growing concerns that inflation could reignite, as expressed by economist Tiffany Wilding of California-based bond fund PIMCO, James Soloway, chief market strategist and senior portfolio manager at Pennsylvania-based Say Investments, and Brent Schuta, chief investment officer at Milwaukee-based Northwestern Mutual Wealth Management Company. Even after accounting for the lagging effects of monetary policy, which can take 6 months to a year to filter through the economy, the U.S. economy is refusing to buckle under the Fed's series of rate increases, which have pushed up borrowing costs by more than 5 full percentage points since March 2022. In January, the U.S. created 353,000 new jobs as unemployment stayed at 3.7%. Business activity growth also accelerated last month, based on S&P Global's U.S. Services Purchasing Managers Index. And now the annual rate of inflation, as measured by the Consumer Price Index for January, is stuck above 3% for an eighth straight month, defying economists' expectations for it to fall below that mark. Today's report was a great reminder to the market of how we still have more work to do, and the pathway is not as orderly as the market was expecting, said economist Lauren Henderson of Stifel, Nicholas & Company in Chicago. One inflation report isn't going to sway the Fed, which is going to look at the totality of the data. That being said, today's report wasn't a great report. This idea of an orderly descent that the market has been expecting seems a little like a fairy tale scenario. Stifel's worst-case outlook is a stagflation scenario whereby growth slows or moderates and inflation remains elevated, which could be potentially worse than a recession, she said via phone on Tuesday. If we do continue to see another month of higher-than-expected inflation, that could certainly change the conversation to additional rate hikes. But at this point, a higher-for-longer scenario is more likely, whereby the Fed has to hold rates at a higher level than the market is expecting. For now, Fed funds futures traders see a 75.8% likelihood of at least a quarter-point rate cut by June, pushing out prior expectations for a move in May, according to the CME Fed Watch tool. They've also pared back the number of rate cuts they foresee by December, with the greatest likelihood coalescing around at least 3 cuts, rather than 4 or 5. A team at Washington-based monetary policy analytics that includes former Fed Governor Larry Meyer called the January CPI report ugly and very strong, in the exact wrong way. Arnim Holzer, global macro strategist at Easterly Ebb Risk Solutions, said the fact that core inflation remains elevated is disconcerting. Inflation is going to prove more resilient, but I'm reluctant to read too much into this, partly because I don't really think it changes the Fed's view, said Mark Chandler, chief market strategist at Bannockburn Global Forex in New York. Considering that the annual headline CPI rate came in lower relative to where it was in December and the year-over-year core reading was unchanged at 3.9%, he said, today's data will be seen as a continuation of the trend of moderating inflation. Regional bank stocks are back under pressure as investors get a dose of reality about obstacles to cutting rates. By Joy Wiltermuth. February 13, 2024, 7:15 p.m. Eastern Time. Shares of regional banks were hit especially hard on Tuesday after an inflation reading came in surprisingly strong, raising more concerns about potential fallout to commercial real estate from higher interest rates. The SPDR S&P Regional Banking ETF KDE tumbled 4.2% on Tuesday, cementing its lowest close since November 30, 2023, according to Dow Jones market data. The market got ahead of itself on the soft landing scenario, said Rich Hill, head of real estate strategy and research at Cohen & Steers, a real estate-focused investment firm with about $83 billion in assets under management. I think we are getting a dose of reality. Hill expects inflation to head lower in 2024, but isn't counting on a smooth path to the Fed's 2% annual target. He also foresees potential for more pain at regional and small banks, particularly for lenders without adequate loan loss reserves that will face a wall of maturing loans and falling commercial real estate market values. I'd be surprised if there wasn't more failures, Hill said, adding that as borrower delinquencies rise, lenders need new appraisals that reflect today's lower property values, which suggests more write-downs on soured property debt at banks. From October, banks fail. It's okay, says former FDIC Chair Sheila Bair. Weak links. Investors' focus has returned to regional banks since New York Community Bancorp Incorporated reported a surprise loss on 2 property loans in the fourth quarter, boosted its loss reserves, and opened the door to potential loan sales. Community banks have an estimated 25.7% direct exposure to commercial real estate as a share of assets versus 4.4% for large banks and roughly 18% for regional and small banks, according to Moody's Analytics. New York Community Bancorp, by contrast, has about a 43% exposure, albeit mostly in multifamily loans. Banks should be pretty well able to weather the storm if problems remain primarily in the office sector, said Matt Reedy, Director of Commercial Real Estate Economics at Moody's Analytics, in a phone interview. Do we think all the pain is over for banks? No, Reedy said. But Reedy also thinks the bulk of the problems in commercial real estate look limited to office space, as far as potential losses lenders will likely face. Office exposure isn't reported as its own category, unlike multifamily or construction loans, but is instead lumped up with other property loans such as hotels and retail. Debt wall builds. Costlier debt since 2022 has weighed on commercial property values, even in the apartment sector, where occupancy rates have remained robust. Many lenders have responded by extending or modifying maturing loans on their books in the past year, but that also has an estimated 20% of the outstanding $4.7 trillion of commercial real estate loans now set to come due this year, a 28% increase from last year, according to the survey from Mortgage Bankers Association released on Monday. These extensions and modifications have pushed the amount of CRE mortgages maturing this year from $659 billion to $929 billion, said Jamie Woodwell, head of commercial real estate research at MBA. Giving borrowers more time to refinance, however, doesn't remove major obstacles for many borrowers, namely that interest rates remain elevated and property values already have fallen an estimated 21% in January from peak levels, according to Green Street's Commercial Property Price Index. Office prices were pegged as 35% below peak levels and apartment values off by 28%. Guilt by association. It's like trying to contain a forest fire, said Bryce Doty, senior portfolio manager at Sid Investment Associates, about the impact of higher interest rates on banks with maturing commercial real estate loans. If rates were lower, it would be like a rainstorm to come and put the fire out. Doty expects the Fed to meaningfully lower rates only in the fourth quarter of 2024, a backdrop in which he thinks avoiding exposure to a broad basket of regional banks in an exchange-traded fund format makes sense. You really need to go bank by bank, Doty told MarketWatch. But he also sees opportunity in discounted senior bonds of regional banks that don't have a lot of office exposure. You can see their stock or bonds have been hurt from guilt by association. While trading volumes were muted Tuesday in the wake of inflation data and a northeast snowstorm, bonds issued by several regional banks have been relatively stable since New York Community Bancorp reported its loan losses, according to BondClick data. Cohen and Steers thinks the worst is likely behind public real estate investment trusts, especially in the months since the benchmark 10-year Treasury yields BX 10Y touched a 16-year high of nearly 5% in October. The benchmark rate was at 4.32% on Tuesday. Private markets for commercial real estate typically lag public markets, which is a reason why Hill sees good opportunities ahead for Cohen and Steers to buy assets at attractive valuations, especially in open-air retail centers. But Hill isn't convinced that multifamily properties will escape even further valuation declines. It could be a good opportunity to buy assets in the future, but the market might be a little bit surprised where valuations go over the next 12 months. The S&P 500 Index SPX and Dow Jones Industrial Average fell 1.4% on Tuesday, while the Nasdaq Composite Index Comp shed 1.8%, according to FactSet. Read next. Here's the investor playbook for making money in commercial real estate as Fed delays rate cuts. Stock market tumble shows investors now face Fed's reality in inflation fight. By William Watts. February 13, 2024, 5:36 p.m. Eastern Time. A frothy stock market suffered a steep fall Tuesday as an unexpectedly hot January consumer price index reading reminded investors that the Federal Reserve's long-fought battle against inflation isn't yet won. The markets just went too far, too fast, and the Fed's reality is setting in right now, said Kent Angelka, Chief Economic Strategist and Managing Director at Capital Securities Management, in a phone interview. Reality can be painful. The Dow Jones Industrial Average dropped nearly 760 points at its low and ended the day down roughly 525 points, or 1.4%. The S&P 500 SPX tumbled 1.4%, while the Nasdaq Composite Comp shed 1.8%. Treasuries sold off sharply, sending yields which move in the opposite direction to bond prices, soaring as traders recalibrated rate cut expectations. The yield on the 2-year Treasury BX 02Y jumped 18.7 basis points to 4.654%, its highest level since December 12. The Consumer Price Index rose 0.3% in January, with the year-over-year rate falling to 3.1% from 3.4% a month earlier. The core rate, which excludes volatile food and energy costs, rose 0.4%, a tick above Wall Street expectations, leaving the year-over-year core rate unchanged from December at 3.9%. Investors were reminded that CPI release days can be volatile. All three major indexes had their worst performance on a CPI day since September 13, 2022, according to Dow Jones market data. Read more. Dow drops after ugly inflation report upsets markets' rate cut expectations. The problem is that investors had thought inflation worries were in the rearview mirror, pricing in as many as 6 quarter-point rate cuts by the Federal Reserve this year and driving the S&P 500 SPX above the 5,000-point milestone last week. At the same time, the Dow Jones Industrial Average notched a string of record-high closes while the Nasdaq Composite Comp approached its own record territory. The Fed, of course, had been pushing back against those expectations. The dot plot forecast had penciled in only 3 rate cuts in 2024, and Fed Chair Jerome Powell and other officials had consistently urged against the notion that rate cuts could come as early as March. Fed funds futures traders have now all but abandoned the prospects of a March rate cut, while pricing in a roughly 37% chance of at least a quarter-point cut by the Fed's main meeting, down from more than 60% on Monday and 100% a month ago. They now see just over a 50% probability of a total of 4 quarter-point cuts by the end of the year. Some observers worried that further rounds of stubborn inflation data could force the Fed, which has so far signaled that its next move will be a rate cut, and investors to change their tune altogether. Given that core CPI came in at 3.9% again and didn't drop to 3.7%, which was the consensus forecast, then it not only throws the timing of Fed rate cuts in question, but potentially opens the door to a possibility that we haven't seen the last Fed rate hike in this cycle, said Chris Zaccarelli, Chief Investment Officer for Independent Advisor Alliance, in emailed comments. Others warned against reading too much into 1 month's data, but noted that the figures would clearly not be read as good news by Fed policymakers. The final mile towards the Fed's 2% target was always going to be slow, erratic and frustrating, said Seema Shah, Chief Global Strategist at Principal Asset Management. Today's data is not what markets or the Fed would have liked to see, but it's important not to overreact and jump to the assumption that an inflationary resurgence is developing. Capital Securities Angelka said stocks had discounted all the positives heading into Tuesday's data, leaving the market vulnerable to a sharp sell-off that was likely exacerbated by algorithmic trading. A near-term pullback could prove healthy for the rally, he added. Based on simple moving averages, a pullback to the 4,800-point level for the S&P 500 would seem reasonable, with 4,600 in sight if that line of support fails to hold. A retreat on that order would actually be healthy for the market to wring out the excesses, Angelka said. We've got to get complacency out of the market, a couple big down days that leave the market down 5% or 8% in a week, and people get really scared.
Today's information is over. Goodbye everyone and see you in the next video.